Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right. Hey guys, Mark Eitel here, and you are listening to the Mr. Mortgage Show. And guys, you are in the right place if you are confused and scratching your head and wandering around like one of those John Travolta memes on the internet, trying to figure out, is housing going up? Is it going down? Where are rates going? What did the Fed mean at the Jackson Hole conference last week when he said there could be more tightening? Guys, we are going to dive into all of that and more. We're going to get to your questions here in a bit. If you have questions or comments, please call or text them over to Jen, who is standing by womaning the hotline. You can get those over to her. 855-462-7292 is the anytime hotline. 855-462-7292, or shoot them over via email, and you can do that by visiting mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot her your questions that way. She'll read them on the air for you. And we're going to dive into some controversy right now. Let's kick this thing right off with some controversial subject about the government rescuing us from this housing crisis, right? We're starting to hear murmurings. California's working on some legislation to try to encourage and stimulate activity, or almost force it, right? That always scares me when the government's going to rescue us, especially when it's from a problem they caused. And we got where we are right now in housing because of the artificially low interest rates, where they actually dipped all the way down to, and the fact that they stayed there far too long. And I'm not blaming, I don't do the one fish, two fish, red fish, blue fish thing. I don't care about politics. Well, I care about politics. I just don't talk about them on the air. My point is, it doesn't matter how we got here. Let's deal with where we are. So these bills that are floating around in this proposed legislation to force activity makes me nervous, right? Because anytime the government encourages or forces unnatural behavior, there's unintended consequences. And we're clearly seeing the unintended consequences of all of the stimulus that got us through COVID. And I'm not arguing that something had to be done. We can look back and say, yes, the Fed should have acted sooner. They shouldn't have kept rates where they were as long as they did. They all told us inflation was transitory and now they can't shake it, right? I totally get it. There's very, very little faith in what we were told, but that's all hindsight. At the time, we were all eating it up. That's why Silicon Valley Bank got in trouble, because the Fed was telling us, yeah, inflation's not a problem, and they're buying more super low interest rate bonds, and that's what caught them with their pants down. But that's a whole nother show. So a couple weeks ago, we did a show about this housing crisis. Is it really a crisis? Fact or fiction, I think I titled it. Because historically in that show, and if you missed that show, guys, go to mrmortgageradio.com and click on that top link. It'll take you to the podcast. We went all the way back to 1900. So we went back 122 and a half years, and we are right where we need to be historically to be on average percentage of the population owning homes. So where's the crisis? The players are playing, right? They always do. They do, whether interest rates are 18% or they're 4%. Historically, we're at the right number. I think what happened was interest rates encouraged everybody to make future decisions now. We had a large segment of the population who was going to move eventually from, the Northeast down to Florida, or from the West to Texas, or wherever they migrated to. Tennessee had a big influx of people. We just encourage them, whether intentionally or not, to do that now. I can only imagine. I'm sitting in my apartment in Manhattan. I can't go to work. I can't go out and socialize. I'm looking out the window of a dreary, rainy day, working on my laptop over Zoom. Hey, I might as well do that from Florida. I'm going to fly down to Jupiter. I'm going to buy a cool townhouse on the water. I can take my boat out. I paid cash for it because I got so much money out of my Manhattan apartment. That's what happened, guys. That was going to happen anyway. It was just going to be 5 or 6 or 7 years down the road. We encouraged a spike of activity in a very tight window of time. You couple that with the rest of the population capitalizing on a super low interest rate in the form of a refi, there's no wonder that the market's slow right now. We're scratching our head saying, why is the market slow? Everybody who wanted to do something in the next 5 to 7 years did it all in the last 18 to 20 months. Of course, it's going to take some time for this to shake out. So I got to scratching my head and thinking, like I do, believe it or not, I do think sometimes, even before I speak. And I tried to find a period of time where we forced, either intentionally or unintentionally, a large percentage of the population to make a decision based on stimulus, right? Well, I found the CARS program. Remember that? CARS? It was what, 2009 or 10, I think? Cash for Clunkers, we called it. I think most of the audience is old enough to remember that. That was an initiative that was encouraging people to trade their older, less fuel-efficient cars in for newer cars that got better mileage. And it was sold to us under the guise that we're putting more energy-efficient vehicles on the road, but it was clearly intended to stimulate consumer behavior because everybody was turtled up after the recession. Man, God, I just had a flashback. I'm literally sweating now because I just had a flashback to living through the mortgage and real estate industry during that time period, because I got involved in 99 and I rode that ugly wave. But anyway, my point is, what did the $3 billion of stimulus do? It encouraged everybody who was going to do something to do it now, to the point that it ran out of money months early and everybody was clamoring to extend it, and thankfully they didn't. But what were the unintended consequences of a big percentage of the population making a tomorrow decision today because of artificial influences? Well, it was interesting. I read a Harvard thesis and I read a bunch of other data, a lot of opinions on this prepping for the show, but the basic summary is that all we did was encourage people to do it now. They were going to do it anyway, but the unintended consequences were mechanic shops suffered because suddenly there weren't a ton of old cars to maintain. The buy here, pay here car lots, which cater to a percentage of the population who has a difficult time buying or financing a car because of credit or employment or otherwise, well, they suffered because those cash for clunkers were destroyed. They weren't allowed to be put into circulation once they were traded. So there were unintended consequences to this stimulus. Another one was charities. A lot of people give their old vehicles, old boats, old cars to charities who auction them off, and that was a significant reduction in their revenue, not to mention the cost burden on the consumer to the tune of $3 billion. So my point in all of that is I believe right now today, as we're doing the show, that we are suffering this lag as an unintended consequence of cheap money. And I don't think it's a problem. I think we're okay if we go through a stagnant period in the market. I think the housing crisis is only a crisis to mortgage brokers and real estate agents because we're feeling the pinch on our side of the fence because activity has slowed. But if you own a home and you've got a ton of equity, congratulations. And if you've got a super low interest rate, congratulations. You made the right decision at the right time, and you should not be forced to make a move nor stimulated to do that. All right, guys, you hear the music? I'm glad I got that out of my system. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And you heard the man, 855-462-7292. That's the Anytime hotline. You can call or text your questions to 855-462-7292, and Jen will get those on the air for you. One more time for the kids in the back, 855-462-7292, or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. You'll find the email icon all the way on the bottom of the page. If you click on that, you can shoot your questions over to us via email. And thank you for letting me go on a little bit about the government-induced housing crisis and how we need to just let things shake out. And I find it super interesting. I looked at that artificial stimulation of the auto industry for that short period of time with that Cash for Clunkers program, and I think you see a lot of similarities in the market right now. And guys, I'm not discounting the discomfort, if you will, that the first-time buyer is faced with. Absolutely, there's a place in my heart for them. We're doing everything we can with grant programs and interest rate buy-downs to really serve that community, because homeownership provides opportunities like none other. It's money you don't have to save. Guys, if you own a home right now, if you've owned it more than 5 years, you never dreamed you would have this much equity. So there's always a benefit to homeownership, tax write-offs, depreciation if it's an investment property. And we don't need homes to appreciate for equity accumulation. You do that by paying off the loan with principal reduction. So I think the housing market, until the supply and demand scale tips in the other direction, and we don't see any reason for that right now, I don't see any red flags other than a lot of frustration. Now, commercial real estate's a different animal, because in the opening segment, we talked about a big percentage of the population made moves because they could work from home. And almost every day or two, there's another headline about a big company trying to, force their staff back into the office, and people are resisting it, at every turn. So I think commercial real estate, office buildings, there's a day of reckoning coming, but I'm in the residential space and I just don't see it at the moment. So that's my whole point in sharing that. I think we could survive a stagnant appreciation cycle, let people stay where they are until they're ready to move on their own. So I hope all that makes sense. Guys, if you have questions or comments, shoot them over to us. I know we've got some back there, so I'm going to toss it to Jen for a question right now. Go ahead, Jen.
Isabella sent this one. I haven't worked for 3 months because of a car accident. I'm living on my Social Security only, but it barely covers the mortgage, and I'm eating up all my savings with the rest of my bills. Is there a refinance that I might qualify for? The mortgage balance isn't high, but the payment is killing me. Thank you both.
Hey, Isabella, thank you for that question. So there's a couple things. I need to know a whole lot more about your circumstances before I could give you a rock solid answer, but I'll tell you where my mind instantly jumped to. And the reason it jumped there was you said Social Security. So I'm guessing that you're over 62 years old, and you mentioned that the Social Security is barely paying the mortgage, which means your debt to income is very high. The amount of money that you're bringing in with just the Social Security compared to what's flowing out, you're probably, spending more than you're making, right? So a refinance or an equity line is going to be based on your income as an ability to repay. Because of that, it's going to be challenging. Now, you can use Social Security income to qualify for a mortgage. And depending on how low your mortgage is, if you extend that out over another 30-year term, it might come down enough that you qualify. So I don't want to discourage you from trying, and I would welcome the opportunity to have a conversation in depth with you about what's going on. But the other place for anybody else out there that my mind instantly jumped to was maybe a reverse mortgage might work. So if you're over 62 and you qualify, a reverse mortgage requires no monthly payments. So that means all of your Social Security can be used for your other expenses, as well as you can either have an equity line or a monthly cash stipend from the reverse mortgage, assuming that you have enough equity to make it work. You said your mortgage balance was small. So that's where my mind went. And I would welcome the opportunity to discuss that with you in greater detail. So I need to know how much debt you have outside of the mortgage, and then what the mortgage balance is in relation to the value of the property to look at a straight refinance. And that same information will help me make sense of a reverse mortgage opportunity, if it indeed is even an option. So I welcome a conversation if you're up for it. I know we have your contact information. I'll have Jen shoot you back either a text or an email and see if we can't set something up though. But great question. Hey, Jen, can you throw me another one?
Lisa sent this email. Are there any equity credit lines for someone with a 641 credit score? My bank said I need 720. I'm hoping you have other options. If you can help, how do we contact you off the air?
Hey, another great question. And we are seeing banks pull back their aggressive equity line programs, and they're doing that two ways. They're reducing the amount of money they'll loan in relation to a percentage of the value, and they're requiring a higher credit score. So we have access to some wholesale channels for equity lines. I'll be happy to explore that for you with your credit score. But I want to throw this out there for someone who may be in a position where they're not going to qualify for an equity line because of the amount of debt or their credit score. And what I mean by the amount of debt, when you apply for an equity line, that's new debt, right? So if you've got a car payment and a credit card payment and a boat payment, and you want an equity line to pay that off, and it makes sense, right? You're going to take all of that debt and roll it into an equity line. That's going to be a challenge, right? Because the equity line is going to treat that as new debt. So it's going to be credit card, boat, boom, equity line. And that's going to affect your debt to income ratio. But with a rec refinance, and I'm not suggesting this is right for everybody, but if you've explored the equity line option and you've been told no, you might want to look at this. You can actually take that credit card, and boat payment out of your calculation now, and we can pay it at closing with the rec refinance. So you're using the future debt to income ratio in today's calculation so you can qualify for a mortgage. That's a big difference in the world of equity lines and mortgages. And people ask me why. Why is that, Mark? Because with the equity line, I'm going to do the same thing. Well, you're asking the bank to depend on you to do it, right? So that's human nature. A lot of people aren't going to do it. But the equity line's in second position. They're in a higher risk position behind a first mortgage. But if you do a rec refinance and that mortgage company pays all that off for you with your money, they're not doing you a favor. They're just saying, okay, before we give you any of the proceeds, we're going to pay all this debt off. They're in first lien position. So they're protected. They have with the exception of taxes and municipal liens, they're the number one position. Taxes and municipal liens always supersede the first mortgage. But my point is there's less risk and they control the payoff of that debt. So certainly something to consider. And we can walk you through that too as an option if we can't find an equity line lender for you with your credit score. But great question. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. We don't need no stinking badges. Who remembers that movie? Now, we don't need no stinking down payment thanks to the expansion of Hometown Heroes. Senate Bill 102 was passed into law, dubbed the Live Local Act. There were a lot of housing initiatives packed into that bill, but the most exciting thing, it broadened the availability of Hometown Heroes. That's right, guys. Now, regardless of your industry, you may be eligible for the program. And it's exciting, guys. Just ask Deb and Chuck, who used the program to move into their new house in Hobe Sound, or Veronica, who's out right now looking at properties in Port St. Lucie, and she's going to use it too. If you've got questions about the program, give me a call at 772-266-0555, or check us out online at MrMortgageRadio.com. That's MrMortgageRadio.com. All right, guys, Mark Eitel here, the Treasure Coast's favorite mortgage guy, NMLS 1929005.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. You heard the man, 855-462-7292. That's the Anytime hotline. You can call or text that number. Jen will get your questions on the air. That number again is 855-462-7292, or head on over to MrMortgageRadio.com. MrMortgageRadio.com. Go to the bottom of the page. Click that email icon and you can shoot your questions over via email. Jen will read them on the air for you. But hey, let's get right to some questions. We started off with some good ones. We talked about reverse mortgage and a debt consolidation refi versus a HELOC. So what is up next, Jen? Throw me another question.
Daniel sent us this one. I heard you talking about the Florida Heroes loan. Is there anything like that for Pennsylvania?
Hey, Daniel, great question, my man. And yes, you would be pleased to know there are a variety of down payment assistance programs that are nationwide. We talked about that Florida Hometown Heroes and their expansion of that program, because when that program was first launched, it was only available to first responders, medical, their teachers, firefighters. There was a category of professions that qualified and no one else did. And, you know, everybody fought tooth and nail for them to expand that, and they recently did. So that's where we were going with that one. But nationwide, there are a variety of programs. And the cool thing is, not all of them require you to be a first-time home buyer. So they'll often give you a grant for your down payment. You can get closing cost assistance from the seller. Sometimes the grant will include a down payment and a bit of the closing costs. And oftentimes they accrue no interest and require no repayment until you sell or refinance the property. And what I mean by that is, it lives out there like a second mortgage, but it doesn't require a monthly payment, and you pay it back when you sell or refinance the property. And there are some straight gift type grants as well. So there's a couple floating through my mind. I would be happy to discuss them with you. If you're open to a conversation, just reach us off the air. You can do that by calling the Anytime hotline, 855-462-7292. But I appreciate that question. Hey, Jen, throw me another question.
Here's a question from Harold. With my Social Security and pension, we're just breaking even each month. We want to downsize to make things easier, but I think we'll be right back where we started expense-wise. How soon after we bought a new place could we do a reverse mortgage on it?
Wow. Man, oh man, we're finding some consistency this week, right? I'm sorry to hear that you're struggling a bit, if you will. And I get it, man. This inflation is not going away fast enough for anybody. So, but you said something interesting. You're hesitant to make the move because you're going to find yourself right back in the same debt load, right? If I'm reading between the lines, and I get it, because when you buy the new place, your taxes are going to be based on a higher value. Your insurance, all of your expenses are going to go up. So I understand the hesitancy, but then you asked how quickly you could do a reverse mortgage. So here's something a lot of people are unaware of. You can use a reverse mortgage as a purchase loan. So you don't have to do that two-step process where you buy the house and then do the reverse as a refinance. You can do it right from the beginning as a purchase. And a lot of times that makes a huge difference on making the move. And I'm happy to walk you through it. Typically how it works, you're going to put about 50% down on the property, and then you're going to move in and not have to make a monthly mortgage payment, which, if I'm understanding your question correctly, is your goal, right? Because you were going to do a reverse mortgage after you moved in anyway. So a reverse to purchase might be the strategy that makes the most sense for you. And I'm happy to walk you through it. It is really, really a neat way to use the reverse mortgage program and just make that transition to downsize or right size or, change locations that much easier. So I appreciate that question, and I'm happy to walk you through it. Just touch base with us, and I'll jump on the phone with you and we'll see if we can't figure this out. Hey, Jen, are you ready? Okay, go ahead.
Here's one from Stacy. My brother told me to wait until next summer to buy a house. He thinks President Biden will lower rates before the election. Does this make sense to you?
Waiting is the hardest part. Man, listen, if that opening segment didn't clearly, and I'm not speaking to you, I don't mean to sound gruff, but I never want to wait on the government to do anything. There were a lot of people who waited on the Biden administration's $15,000 first-time buyer grant. How many of you remember that during the campaign season? They were talking about that, and they couldn't get it over the finish line. And I don't think it was a bad idea, but people were waiting for that to happen, and it never happened. A ton of people were waiting for student loan forgiveness. Well, that hasn't happened. It's happening in a modified form, but I'm not a fan. And the president, whoever he is, doesn't control the interest rate. So he doesn't have a magic wand, clearly, or he'd be waving it right now. So if you're waiting solely on the interest rates to change before you make the move, I'd look to see if you can make the move now, because what's going to happen if interest rates go back down? Are we going to have a surge in activity, and then it's going to be a whole nother set of problems? I don't have a crystal ball. I just know that the president in and of himself does not have a direct impact on where interest rates go. So I know a lot of people say election season. There's all this, I don't know. I don't buy into that, but I appreciate the question. Hey, Jen, throw me another one.
Here's an email from Oscar. I watched a video on TikTok about a type of equity loan you don't have to make any payments on. Is there really such a thing?
Hey, Oscar, what are you doing on TikTok? I see the craziest things on TikTok, and this is one more of them. Actually, yes, there is such a thing. It's called an equity sharing agreement. And basically, you're just selling an equity position in your property. And whoever is giving you that money is banking on, I think there's 3 or 4 companies doing it now. They're banking on the property going up in value. So if they give you, $50,000 for 10%, and in 5 years the house is worth $600,000, they made money. But yes, it's called an equity sharing agreement. Yeah, I'm not sure that I love the idea, but they're out there. And, if you're in a pinch and you can't make the payments, I don't know. I don't want to encourage you one way or another, because I don't know your personal circumstances, but it's not a loan. You're selling an equity position in your property. So if you want to walk through other options, just give us a call or shoot me an email, and I'll jump on the phone and walk you through some other options, and then you'll have all the information you need to make a decision. But yeah, TikTok, here we go again. All right, Jen, throw me another question.
Natalie sent us a question. We found a home with an assumable FHA mortgage. We want to buy it as a rental property. How do we start the process for an assumption?
Hey, Natalie, that is a very easy question to answer. You can't assume an FHA loan if it's going to be an investment property. It has to be your primary residence. But if it was going to be your primary residence, this is for everybody else out there, you call the servicer, and the servicer is the company that the seller is currently making their mortgage payment to. You don't go to your bank. You don't go to the Mr. Mortgage team. You call the servicer, and that's who facilitates an assumption. But sadly, in this instance, with it being an investment property, you're not going to be able to assume it as an FHA loan. But great question. I appreciate that one. You hear the music, guys. You know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We're coming right back with more of the show. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at mrmortgageradio.com. That's mrmortgageradio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, if you have questions or comments, you want them on the air, just call or text 855-462-7292. That is the Anytime Hotline, 855-462-7292. Call or text that number, and Jen will get your questions on the air for you. Or shoot us an email. You can do that by visiting mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way. Jen will read them on the air for you. But hey, Jen, let's go ahead and rip through a rapid round of questions. How about it? What do you got?
Kevin sent us this. Can you explain the house layaway plan you mentioned last week? I think that's what you called it. It's a way to buy a house now and sell it to my grandson later. Thank you.
Hey, I absolutely love this question, and thank you for paying attention. That's right, we're calling it the First Home Layaway Program. Super excited about this one because we talk about it all the time, finding the opportunity instead of the obstacles, right? And we open the show talking about the equity position people have right now. They've never been this house rich before, right? So here's the thing. We also talked about the first-time home buyer and the hurdles they face moving forward. It's going to be a real struggle for somebody out there trying to buy a house. Now, if you're sitting at home with an 8 or 10-year-old who's not the next Elon Musk or Steve Jobs, you're thinking to yourself, man, I love my son, but he's not bright enough to go out there and be a millionaire. How is he ever going to afford his first home, or in this case, your grandson? So here's an option, right? You could, and a lot of people are looking to do this, and we're talking to more and more people about this strategy. We're doing an equity line. They're pulling some equity out of their property. Then they're using the landlord loan to buy a home that they're renting out. Now, the cool thing about the landlord loan, no personal income is underwritten. We're looking at your credit and your assets, and we're looking at the income from the rental house. So you pull your equity line, or maybe you've got other capital and you don't even have to pull your equity line. That makes this even easier. You put that cash down on a property and then put a tenant in there, and little Johnny or Jimmy or Susie, who's 8 or 9 or 10 or 15, doesn't matter how old they are, at some point they're going to be ready to venture out on their own. And what is that, 10 years? 5 years? I don't know what the time frame for your grandson is, but in theory, the property is going to be worth more because we don't have a crystal ball. But historically, we can believe that the property will be worth more. But more importantly, someone has been paying down the principal for you. So you're building equity each month in that property. If it's 10 or 15 years, that's even better. It's a more significant equity position. Then when they're ready to venture out on their own, you can sell them the property and gift them enough equity to cover their down payment and closing costs to a point that it makes sense for them to qualify. And at that time, you can extract your equity that you originally put down out of the property. So it's a really interesting idea that people are looking to one, stave off future crisis with their kids not, or grandkids not being able to buy that first home, and also provide some income stream for them along the way as the tenant is reducing the principal position and building equity. And the really cool thing is if you don't need the income position, just pay down the principal even faster, depreciate the property, take all the tax benefits of owning a rental property, but you're setting your children or grandchildren up for an opportunity that they're probably going to have a difficult time doing on their own. So that's the whole strategy. I hope it makes sense. I would love to talk to anybody in detail about it, run the numbers for you, and see if it makes sense for your personal situation. But I appreciate you paying attention. We're really excited about that one. Hey, Jen, do you have another question?
Art sent us this. Okay, if we do a reverse mortgage, what happens to my wife when I die? Will she have to sell the house? She's quite a bit younger than I am, so I think I'm going first. I don't want to leave her in a mess.
Hey, Art, that's awesome, brother, that you're thinking that far ahead. I commend you for that. And also, congrats on having the young trophy wife, my man. I'm kidding. But all kidding aside, this is a great question. So the younger spouse, or the second to pass, if you will, right? You're a married couple, the husband goes first, the wife gets the full benefit of staying in the property until she dies or sells the property. So the bank is not going to force her to make a move before she's ready. She doesn't have to pay the loan off. She doesn't have to sell the property. She's going to have the same benefit to staying in that property until she's no longer able to or no longer interested in staying in that property. And guys, here's something interesting. Even if the younger spouse is under 62, this can still work. And we've done it in the past. We had a spouse at 58 and we were able to make it work. So I encourage you, if you are, and it sounds like based on the calls today that we're definitely moving into a time where more people are looking at their equity as an option to kind of lessen the burden of inflation and monthly expenses. So if that's you and you want to have a discussion about this, please reach out. I welcome the opportunity. You can go to mrmortgageradio.com and click on that More About Reverse link. That would be a good way to get started. And I welcome the opportunity to talk with you in length about this. Anybody who knows my story knows why I got involved in reverse mortgages. And it was my mother, and she was seriously considering it, and I wanted to learn everything I could before she made that decision. And we were able to work a plan with her that didn't require a reverse mortgage, but it was because of that I didn't want her to be sold on anything. I wanted her to make a decision with both eyes open. So anyway, I appreciate that question, and I'm happy to help any way that I can. Hey, Jen, can we squeeze in another question?
Cornelius sent us an email. I'm looking for some rental properties with my brother. How do we calculate the potential income on a vacant property? I know the appraiser will calculate it, but is there a way to get an idea before we get too far into the deal?
Cornelius, my man, my favorite name of all time. I got to tell you this story. I was at a trade show in Chicago, and if you've ever been to the Merchandise Mart in Chicago, that's where they call it the Loop. And the train station is down under the Merchandise Mart. And it's like the Grand Central Station of Chicago. People come and going. And I was in the Merchandise Mart for a conference. And there was a Jamba Juice. And I walked into the Jamba Juice. And you know, any of the beverage type fast food places, Starbucks, whatever it is, they ask you for your name. Well, it was cute because I had my name tag on my shirt. And the young girl asked me for my name. And I was just being a bit of a, smart aleck. And I said, well, my name is Cornelius. And she never looked at my name badge. So this went on for 5 days while I was there during this conference. So she was a little confused and she had a hard time spelling Cornelius, but gosh, she made a heck of an effort. And the last day I was there, maybe 4 or 5 days into this, she said, hi, Cornelius, are you going to have your normal with Strawberry Dream or whatever they call it, Orange Sickle? I don't remember. But anyway, I said, yeah, absolutely. So she had looked up on Google and had the spelling perfect. I mean, her handwriting was perfect. It was spelled perfectly. And she said, here, Cornelius. And she turned the cup towards me. And she said, I learned how to spell your name. And I looked at her and I said, yeah, but I spell it with a K. The poor girl's face just melted, and I had to let her in on the secret. We both had a good laugh. So anyway, I just had to tell that story because we don't come across too many Cornelius. I think most Cornelius go by Neil. But anyway, my man, sorry to get sidetracked. I just wanted to share that. So to answer your question, you're right. The appraiser will put together what's called a comparative rent analysis. But if you want to cheat on it and you want to, the inside info and a shortcut, I guess not cheat, that's not the right word. Go to mrmortgageradio.com and click on that free value report link. And in that value report, it'll give you a market value at resale, but it will also give you a rent comparison. Now, that's based on general market conditions, but it will certainly get you started. So head over to mrmortgageradio.com and click on that free value report link. I think you'll find that helpful. So anyway, I didn't mean to get sidetracked with my fun and games at Jamba Juice, but that's a peek behind the curtain. I like to have fun. So she was a sport, and I commended her for taking the time to learn how to spell Cornelius. All right, guys, you hear the music. You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. We don't need no stinking badges. Who remembers that movie? Now, we don't need no stinking down payment thanks to the expansion of Hometown Heroes. Senate Bill 102 was passed into law, dubbed the Live Local Act. There were a lot of housing initiatives packed into that bill, but the most exciting thing, it broadened the availability of Hometown Heroes. That's right, guys. Now, regardless of your industry, you may be eligible for the program. And it's exciting, guys. Just ask Deb and Chuck, who used the program to move into their new house in Hobe Sound, or Veronica, who's out right now looking at properties in Port St. Lucie, and she's going to use it too. If you've got questions about the program, give me a call at 772-266-0555, or check us out online at mrmortgageradio.com. That's mrmortgageradio.com. All right, guys, Mark Eitel here, the Treasure Coast favorite mortgage guy, NMLS 1929005.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, my name is Mark Eitel, and this is the Mr. Mortgage Show. Did you see that, Jen? I'm laughing because most of the time when that intro brings us back in with that kind of like that Rocky vibe, that boxer vibe, I'm jumping around back here and I tripped over the mic cable. I'm standing today and I tripped over the mic cable, almost busted my butt. But anyway, guys, Mark Eitel here. This is the Mr. Mortgage Show. Questions or comments, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Jen is womanning the hotline. She'll get your questions on the air, or shoot us an email, and you can do that by heading over to mrmortgageradio.com. That's mrmortgageradio.com. And on the very bottom of the page, there's a little email icon. Looks like an envelope. Click on that, and you can shoot your questions over to her, and she will read them on the air. But speaking of, I'm going to sit down now. Yes, I hear you. Speaking of questions, and Jen, I'm going to toss it her way for another question. Go ahead, Jen. What do you have?
Here's one from Hannah. We've put off refinancing for a while, thinking rates were coming down, but my daughter and 2 grandbabies just moved in and money is tight. We'd like to pay off my car and my husband's credit cards. Can we pay off my daughter's car too, even though it's not our debt?
Hey, Hannah, great question. Congratulations on having your daughter and grandbabies with you, if that makes you smile. Man, I'm sorry that you're feeling the pinch, though. But yes, with the rec refinance, we can pay your debts off at closing, and you can even pull a little additional cash out, assuming that you have enough equity in the house and your ratios work, you qualify for the new mortgage. You could pull enough out to pay off her car as well, if that makes sense. So as long as there's enough equity and you qualify, you can do the debt consolidation piece and pull a little bit of cash out to pay off some, in this case, additional debt, your daughter's car payment. So congratulations on being in the position to be mama hen and give them, the sanctuary of a home. And guys, that's another reason why home ownership is so important. If you're sitting at home right now, encourage the people around you to put themselves in the same position that you're in if you are indeed a homeowner. So happy to help any way we can, or I'd welcome the opportunity to do the rec refinance for you. Just reach out and we'll set up a time to talk. Thank you for that question. Go ahead, Jen. Throw me another one.
Glenn wants to know, do you think rates will hit 8% before the end of the year? If so, will this finally crash the market?
Hey, Glenn, I don't think rates alone are going to crash the market. And the market's performance over the last year has kind of proven that. It's interesting that you say 8, though, because I was asked in an interview at the beginning of the year, do I think rates are going to hit 4%? And I said, I think they could hit 8. So it's interesting. I don't know. If you would have asked me last week, I thought we would get there a lot sooner than before the end of the year, but it's hard to say. We've been bouncing around in this range. We've been going from the high 6s to mid 7s for a while now. So I kind of feel like this is where we're going to be, but nothing surprises me anymore with what's going on in the market. But to answer your question, I don't think rates alone are going to crash the market for all the reasons we've talked about so far today. People are just sitting in a great position with fixed rate mortgages, a ton of equity, and the majority of people have a low interest rate. So there's just not, I don't see people being forced to sell anytime soon. But great question. I'd be happy to have a conversation over a cigar and a glass of scotch with you one day about that. But anyway, hey, Jen, throw me another one.
Here's an email from Sherry. We said we were never going to refinance, but we got in over our heads with the bills. So if we refinance now and then again in a couple of years, are there any closing costs we can avoid the second time?
Great question. Yeah, this is a tough one, right? Because going through a refinance, there are closing costs. So you're eating up a little bit of your equity every time you do a refi. So I certainly appreciate your hesitancy to have to do it twice. Ideally, you'd be in the position to wait until rates were in a softer position. But to answer your question, what we're doing, at least here, my team, is we've set up a strategic refinance. So we're going to waive as many of the fees as we can, and we won't know until we get to that interest rate environment what we're going to see. We just saw the government change the loan level pricing adjustments earlier this year. So that's why I'm saying we have to wait and see. But our goal is with the strategic refinance, no origination points, no discount points. We're going to waive the appraisal. We're going to try to eat as many of the fees as possible for this exact circumstance, because with the exception of holding on to your title policy and holding on to your survey, because those two documents you're going to need to have reproduced when you do a new refinance. If you've got the survey, you sign a survey affidavit that the footprint of the house hasn't changed since that survey. That's going to save, whatever the survey cost is. In my market, that could be $400, it could be $1,400. And then the reissue policy for the title insurance is going to save you some money. But talk to someone, and I would love it to be us, about setting up that strategic refinance so that as many of those additional costs the second time around can be avoided. But great question, and I'm very impressed that you're looking that far ahead. That was a brilliant question. I appreciate that one. And anybody out there that's finding themselves in this circumstance, you feel like you waited too long and now you have to do it, and you're going to refinance another time in the future. And guys, this goes for people buying right now too. This strategic refi program, we're using it for people that are purchasing with interest rates in the high 6s and mid 7s, and setting it up so that they'll be alerted at a certain trigger point when it makes sense. We discuss those trigger points ahead of time. And if we're in a descending interest rate environment and 6% your trigger point, and we call you and you're at 6%, but it looks like we're going to go to 5.5%, then we'll hang in there and do the refinance at 5.5%. But that's a great question. I certainly appreciate it. I hope that helps. I'd be happy to walk you through all the details around that strategy. So great question. Hey, Jen, throw me another one.
Denise sent this text. Are there any special mortgage programs for buying, remodeling, and reselling homes?
Hey, Denise. Yes, those are called fix and flip loans. And yes, they're out there. There's two numbers that you're going to want to hone in on, because you're going to be able to finance your purchase price and a percentage of the rehab. So you'll hear a couple of terms, right? You'll hear a percentage of cost, and you'll hear percentage of after repair value, ARV, gets thrown around a lot in the fix and flip world. So if you're buying a property for, let's just use round number, $70,000, I know there's none of those out there. And it's going to cost you $10,000 to renovate it, but you're going to be able to sell it for $100,000. Your loan is going to be based on the after repair value or the cost, usually whichever's less, a percentage of either. So it gets a little complicated in knowing exactly how much you can borrow. But yes, there are fix and flip loans out there, and you're going to want to pay attention to those two numbers. Percentage of cost and percentage of after repair value are the two biggies. Hey, Jen, let's try to squeeze in one more.
Here's one from Sydney. My golf buddy says a reverse mortgage will disqualify us from Medicare. Is this true? We can't afford to lose our insurance. We can't really afford to keep our house either. Not sure what we should do.
Wow. So, Sydney, I would love to talk to you in length about a reverse mortgage, because maybe a reverse to purchase makes sense if you don't want to keep the house, if you can't afford it. Maybe the reverse mortgage takes the pressure off and you can stay there. But to the Medicare question, Medicare and Medicaid are two different things. I haven't seen a reverse mortgage disqualify somebody from Medicare, where he may be referring to Medicaid, which is based on financial need. So yes, Medicaid could be affected by the proceeds from the reverse mortgage. And I can happily introduce you to somebody you can talk to about that. But Medicare is a completely different animal. And if you have Medicare insurance, you're most likely going to be fine. So I just would want to make sure we're talking about the same thing, because Medicaid and Medicare often get confused. And one is based on financial need, and entitlements that are based solely on financial need may be affected by a reverse mortgage. But brilliant question. Let's dive deep on it, though. I welcome the opportunity to talk with you more about it. But hey, guys, you hear the music? You know what that means? That's my cue. No, it's not my cue. It's time to get out of here. Man, oh man, we wrapped up another week here at the Mr. Mortgage Show. Time flies when we're on the air. Guys, thanks for hanging out with us. If you need us during the week, just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. All our contact info is there, MrMortgageRadio.com. Otherwise, Jen and I will be back next week right here. Same time, same station. Guys, have an amazing week. We'll see you next week. Be good.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.